Welcome to the second video for Chapter 5. Let's look at Cedar Fair Limited Partnership Consolidated Statement of Cash Flows. The statement shows activity for a period of time and how and what changed cash. The amounts are expressed in thousands. You can see three sections: cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. The first section is always the operating activities. The section is prepared using the indirect method. How I can tell is by its beginning. It starts with net income in 2008 and 2009, and in 2010 it started with net loss. After that, there are adjustments that reconcile net income or net loss to net cash from operating activities. We have a number of adjustments which are not particularly comprehensive. The actual preparation of the statement is outside the scope of this course, and I am not going to spend time on it. You will study these adjustments in great deal in Intermediate Accounting 2 course. When analyzing the operating activity section, it is best to focus on the very beginning and the very end of the section. Cedar Park was profitable in 2008 and 2009, which is fantastic, but in 2010 they faced a net loss. When assessing the severity of the loss situation, you need to look into the other financial statements, especially the income statement. It could be a big deal or just one-time thing. At the very bottom of the section, we can see that the company was able to generate cash, a little over $182 million, even though their operations were losing. This statement focuses on cash, so that means that they received more cash from operating activities than they paid cash for operating activities. It still doesn't decrease the importance of the fact that they faced a loss, but at least it ensures they were bringing in cash from their daily operations. I want to show you how the operating section prepared using the direct method looks like. We see cash received from customers, cash paid for food and merchandise, operating expenses, selling, general and administrative, cash paid for interest, taxes, and other. In the end, we see a figure which shows the difference of cash receipts and cash payments. This method is very understandable, and users, of course, prefer it. However, the way the information is recorded under the accrual basis of accounting does not easily provide these figures. The accounting department has to go through a lot of analysis and data manipulation to arrive at these numbers. That fosters an environment where a lot of mistakes can occur. GAAP recognizes this, and it requires companies who use the direct method to reconcile it by preparing the section using the indirect method. You can see that creates double the work, and as a result, more than 95% of the companies choose to use the indirect method. The other two sections are prepared in a very comprehensive way, and we will see outflow or a negative number when money is spent, and cash inflow or a positive number when cash is received. The investing activities section shows changes in long-term asset accounts, that is, long-term investments, property, plant and equipment, and intangibles. We will see inflow when long-term assets are sold, and we will see outflow when long-term assets are bought. Now, in order to live off of cash inflow from investing activities, the company has to be selling off its long-term assets. If they rely on this for cash on hand, resources they keep selling are limited, and after time they will run out of long-term assets. Not to mention that without property, plant and equipment, it will be quite difficult completing the day-to-day operations. Cedar Park spent approximately $72 million in 2010, $69 million in 2009, and $83 million in 2008 for capital expenditures. That means that they're acquiring new or renewing existing capital assets. They sold the Canadian real estate in 2009. In this section, we will look into every item that occurred and the bottom line as well. The general benchmark is that we see cash outflow for investing activities. Even though it is a negative number, we will consider it as favorable, because again, that means that the company is growing, acquiring new fixed assets. A note of caution: Some companies grow too fast and cannot sustain their rapid growth. It is not a bad idea to look into signs to foresee and avoid investing into a company that may default. If we see cash inflow or positive numbers for a section, it will be a warning sign because they may be liquidating the assets, which in turn may mean that they are either shrinking or going out of business. The financing activities show changes in long-term liabilities and equity accounts. In this section, we will focus our attention on the individual items that require spending or bringing in cash. For Cedar Fair, we can see that they have a revolving credit loan and in 2010 spent cash to pay off $86,300,000. In 2009, they borrowed, and in 2008, they paid off. When the company borrows, we will see as positive number, and when the company pays off, we will see it as a negative number. Paying off is considered favorable because they are able to pay their obligations. When they borrow, we should be cautious. It is a good sign because creditors found them worthy, but having long-term debt exposes the company to more risk of default. In 2010, they borrowed from revolving credit loans and they got into a term debt borrowing. So there is a cash inflow for $1,175,000,000. On the next line, we see that they paid off term debt including early termination penalties. Without looking at the notes and other financial statements, I'm guessing that they retired old bonds and issued new ones to lower their interest rate. This is happening around the time during the financial crisis when interest rate dropped significantly. Now keep in mind that Cedar Fair is a limited partnership, not a corporation. The authors probably chose that type of entity for you to see that the statement of cash flows is necessary and is prepared for any form of business. Limited partnerships don't issue dividends, but they pay distributions to their owners. So the line distribution paid to partners is the equivalent of dividends for a corporation. Even though this is an outflow, we consider it favorable because the company takes care of their owners and shares some of the profits with them. The bottom line of net cash used for financing activities is $112,698,000. We don't have a benchmark to look for a positive or negative number like we did for the other two sections, but we will investigate and try to label each transaction as either favorable or not. At the bottom of the statement, we see net change in cash for the year. Cedar Fair had a net decrease of $2,163,000, which means that their cash decreased from the beginning to the end of 2010. We have a reconciliation section where the beginning balance plus or minus the change would equal the ending cash balance, and this can be tied to the cash balance that appears on the balance sheet. To summarize, favorable is to see significant positive inflow from operating activities. It will be considered favorable to have cash outflow for investing activities, and for financing activities, we will look into the separate items. IFRS Insights. The statement is required under both GAAP and IFRS, having three major sections: operating, investing, and financing. Similar to GAAP, the operating section can be prepared using either the indirect or direct method. The indirect method is widely used under both GAAP and IFRS. Analysts commonly use the following ratios to better understand a company's ability to generate cash. Free cash flow equals net cash flow from operating activities minus capital expenditures minus dividends paid. The ratio measures how much cash is available for growth and financial flexibility. Cedar Fair's free cash flow was especially impressive in 2010. That was due to a significantly lower distribution to partners, which makes sense given the fact that the company faced losses. Cash flow adequacy equals net cash flow from operating activities divided by the sum of capital expenditures and dividends paid. The ratio measures company's ability to pay its annual payments for capital expenditures, dividends, debt, etc. Cedar Fair's cash flow adequacy was good all 3 years because it was above 1. However, it was especially impressive in 2010. Cash flow liquidity equals cash plus marketable securities plus net cash flow from operating activities, and that whole sum is divided by current liabilities. The ratio compares cash resources to current liabilities. This is a cash basis measure of short-term liquidity that is similar to the current ratio. Net cash flow from operating activities is included in the numerator because this is a likely source of cash that will become available to pay current liabilities. Cedar Fair's cash flow liquidity was good all 3 years because it was above 1. However, it dropped significantly in 2010. Quality of income equals net cash flow from operating activities divided by net income. The ratio measures how net cash flow from operating activities compares to net income. A ratio of 1 or greater will indicate a high-quality income that is supported with cash inflow from operations. In 2010, there was no income, so this ratio would not apply. In 2009, quality of income dropped significantly compared to 2008. And that wraps the video for Chapter 5. Thank you for watching.